I'm top Orlando Realtor Scott Garrison with Remax Town & Country, East Orlando's #1 real estate company, with my partner Realtor Deanna Sacoto. And we're here with Steve Ruff and Stephen Vettorel of First Down Financial. And we're going to find out why you should get a fee-only portfolio manager or retirement income advisor. That's why we're here.
We know those guys.
So tell us a little bit about your company first, just kind of what do you do in the big picture? A lot of people are saying, well, what did I just say? What is that? What do you do?
First Down Financial, we're a complete nationwide firm that does everything from assets under management to annuities, retirement planning, tax strategies. We pretty much do everything full service.
That sounds great. So if you're a person who's watching this and you say, what could they do for me? What is it that the person would think they would want to hire you for? Why do people go to hire you?
Typically when they're looking for a wealth manager, at least a lot of the modern firms out there that are sort of a full picture, they provide all the services for clients just like we do. We are not CPAs, we're not estate planning attorneys, but we can help steer a lot of the decisions surrounding how an investment structured in relation to a trust, and obviously the tax strategies we're going to talk about today. But the sophistication of some of this it can be quite easy to understand. It's just a matter of doing the right thing for the client, which is most important to us.
How would someone know that they need you if they think they don't?
We can talk for an hour on this subject.
Being full service on there, there's not a situation I think that can't utilize our firm on there, because whether it's taxes or growth of a portfolio or how to structure an estate, pass down estate, a legacy plan, pretty much all situations we could help a client navigate their situation.
Okay, good. Are you actually setting up trusts and doing estate planning, or is that somebody else?
Depending on the complexity of the trust, we can guide the client through an interview process to set up a trust through several sources we have. For a more complex estate, Steve and I have many different estate planning attorneys that we can refer them out to for a more complex or any more, especially when it comes to like a child trust and things like that for special needs.
Okay, great.
Or a charity.
So these are going to be some simple questions. So you're a fee only, right? And what's the opposite of fee only?
It's commission based.
Okay, commission based, and that would mean that they only make money when they do what?
The key thing to understanding the best wealth manager for you is finding a firm that is nationwide, that is a fiduciary, which means just like a doctor and lawyer, we put a client's interest first. We are a fee-only firm, meaning that we don't have any of the conflicts of interest that a brokerage firm would, because we're an independent RIA, which is a registered investment advisor. Okay. Steve and I are the owners of the firm. Nobody's telling us what to do. We have connections with every investment opportunity out there. We can be completely unbiased in how we provide the advice. That's really the key. You want to find independence. Nobody's pulling those puppet strings, as I often joke about big brokerage firms.
Yep. So somebody's watching this and thinking, that sounds cool, but I have an E-Trade account and an IRA and I do it myself. And how much would this cost? Why would I call you?
I mean, our fees start at 1.5% and go down from there, depending on the assets that we manage. But
that's 1.5%.
1.5%
per year of the amount managed, correct?
Correct.
Okay.
So if there's $1 million in the account, it's $15,000 a year. We think it's tremendous value for the client in relation to what we do in terms of helping grow their wealth.
Because you are going to help them to grow way more than 1.5%.
We have such sophisticated strategies of how we manage portfolios, from Steve's expertise in retirement income planning to what I do in the investment management side. There's far more value there in terms of the performance. Past performance, I always joke, is no indication of the future, but the vast majority in this industry stick to a particular model that's static. Maybe it's 60-40 or whatever the blend may be in terms of diversification. We are much more strategic and tactical of how we operate those accounts for clients. So we're not just following along with the market. We want to outperform whatever the benchmark is and do with a lot less risk and lower fees.
So if somebody has a couple $100,000, a couple $1 million, you're saying that paying you 1.5% per year you're gonna make them way more than that.
What we've done in the past, don't see any reason why we wouldn't in the future. So I was banged in my head by one of my former mentors, Ken Fisher. So you got to provide value to the client.
Oh, that's
Every year.
Much of what Steve does on the expertise he provides in both the life annuity and the retirement income planning arena, he's sort of the expert at the firm on that. There's no fees to any of that. In some cases, very little.
Yeah, I think some of the fees, as far as the assets under management, is fee-based, but a lot of the annuities we do in the planning is zero fees on there. So that's zero fees, and basically, from a risk analysis to a full estate analysis, there's no charge for that either. We can do that for free. Just basically go over and do a whole overview of a portfolio and just say some of the strategies that we can implement. And a lot of clients are shocked. A lot of times there is no fee at all. We're paid directly from insurance carriers, so they pay nothing. And there's even bonuses that can put them ahead. And not only do they not pay a fee, but can get bonuses as well. So we've got some real good strategies for them.
So if someone's thinking about hiring you, where in their wealth creation of their life, where should you come in? A lot of people are going to say, I don't have enough money for you to manage.
So,
Doesn't matter.
when we get the
I
meeting.
say I can't afford it. So where should they contact you? Where does it become worth your while, where your returns can be worth your while and their while?
I think, again, to me, it's better earlier than late, because even at the beginning, you got a family and you're young and don't have a lot of money, you still need a family protection life policy. Okay, you need a strategy on IRAs, Roth conversions. So I think you're never too early to start, because again, a lot of mistakes that are made are individuals aren't taking advantage of Roth, and they're just started a 401k plan at work, and they're going 401k versus Roth 401k, or Roth versus traditional IRA. So those are some of the things that if you start early, the accumulation tax-free can be, ridiculous on how much you can make by doing the right strategy early. So it's never too early to get information.
But what do they need, like 10,000, 20,000, 50,000 to
Million.
start?
Start with $5,000.
Five
Like a Roth
grand.
IRA.
So if someone has 5,000, they can come.
Well, like I said, we start with some young families, and they just needed simple term policy. A $50 a month term policy. On there, we start with them on there. I mean, I've got over 100 physician clients now, and a lot of them I started their practice just started, and they've got student loans and they've got everything, and they don't have a lot, but we did a disability policy for a doctor, and then we kind of grew from there. So again, it's really just evaluating what your goals are, and then we can go ahead and set up a plan to meet those future goals.
How long does the average client stay with you once they come to you and say, okay, go ahead?
Yeah, I mean, clients don't leave us. I mean, this typically they don't leave us unless it's death or divorce. I mean, the attrition rate of first down is ridiculously low. Again, provide value for the client, help them with all of their wealth management, estate planning, as well as do with high performance is really the goal.
We got the generations. It's on there where I've had worked with some of the grandparents now that now work with their kids and even work with their grandkids on there. So I've been doing it 41 years now. So we work through generations of families. So it's lifetime as far as we work with clients for life.
So do you both live in Oviedo?
Chuliota.
I live in Oviedo, yes.
So here at East Orlando, are most of your clients local to you in East Orlando, or are you looking for clients in Florida, California?
We have a lot of clients locally, but we're a nationwide firm. Steve's got clients in Hawaii and Alaska. These are two very underserved markets, frankly.
And do they want to meet with you personally, or is it all over the phone or through Zoom? How do you interact with those clients?
We do both on there. I travel a lot, going out to Hawaii, Alaska, Montana, for clients out there face to face. So we'll go over there. A lot of time we'll start off Zoom and get to know the client situation, and then we'll book several appointments in an area. But we've got clients in 46 states right now on there. But like I've got a big client base on 3 major islands in Hawaii and in Alaska. Fun places to go. So
How you suffer having to travel to Hawaii?
He loves it.
That must be
yeah,
horrible, right?
yeah. It's like I said before. It's it's good to meet face to face with clients and meet new people.
So do you work with international clients?
We can't even work with international clients as well. They meet here in the U.S. and there's a lot of companies. We set up a lot of life insurance and tax strategies for nationals that come in as far as that we work with them in multiple different countries.
Give me an idea of who would not be a good fit for you. Because it sounds like you're saying the guy at Taco Bell, the kid, the old lady, everybody, and that may be true, but who would not be kind of the right person?
Typically, the individual that just chooses to put it all on black at the casino.
Okay.
Probably not the best fit as a client, right?
What does that look like with their finances? They're putting it all on black.
Mostly they gamble it all away in many cases.
Okay.
So we try and get them to invest and to save and to make the correct decisions surrounding your portfolio. So
How much time do you spend with a client per year? What's the interaction look like?
it really just depends on the client. Steve and I we've had 6 meetings in some cases before we brought a client aboard. Ideally, we want to be doing a risk analysis in the second meeting of all their investments. That's ideal. And then moving forward, presenting the proposal and then the implementation happening in typically meeting 4 or 5.
And then on an ongoing basis, what does that look like for the customer?
Every year?
Many of my clients, I talk to them every month.
Okay.
Usually it's twice a year review, but we will do meetings more if the client desires that as well on there. Change their life plans. When life changes, they really want to talk to us. Inheritance or as far as going to a nursing home or long-term care situation, college plans for kids. So when a change comes on, they'll call us and we'll go through that situation.
So if someone goes to a retirement home, do you still keep taking care of their assets?
Yeah, usually as far as it's based on cognitive. Do they have the ability to communicate? If not, we're dealing with the family members for those assets.
And what about if someone doesn't have a family?
Then as far as that when it goes in there, there's somebody that's handling their estate, whether it's a probate attorney or somebody else on there. It could be charities we're working with on behalf of the client. So on there, a lot of times we'll have instructions from the client, and then we'll just direct assets the way the client wanted them to go.
Okay.
What do you find the biggest challenge is in growing your business and getting more clients?
Steve's on the roll.
The challenge as far as that is getting word out on there. You're a nationwide firm. There's obviously a lot of pockets that they don't know who we are. So it's really using social media, promotion, seminars, advertisement, word of mouth to just get the word out about your firm on there. Because again, we're not a major firm on there. We're a small firm, but again, we do what the big firms do, but we do it more personal as well.
Yeah, it's more personal, so then it's you, and I know that your children work with you.
Yeah, I've got my whole family, 4 kids working for me now. I worked with my dad before, so as a family, we've been doing this type of business for 55 years.
Steve, tell me, what is it that you're really good at? When someone were to sit down with you and they say, all right, I want to talk to you about my wealth, you've got some things that you're thinking, I'm really good at this part. Can you kind of put that in words for like what the strength is?
I think Steve and I and everybody at First Down are really good at making sure we deliver what the client's actually looking for. That's the key. So obviously, estate planning just seems to permeate everything we talk about in discussions. You're not really growing wealth inside of it. But if you don't structure the estate plan correctly, it's all kinds of taxation that can just absolutely hammer the estate. So it is critical the client understand that. Maybe a fairly boring area to talk about, right? But it's critically important. Outside of that is what is the risk associated with all the different asset classes that a client may have, right? And what is the diversification across those asset classes is critical to understanding the risk involved, if at all. So if a client would pin me down and say, well, what do you think you're best at? I would say, I think we're best at delivering the entire package for a client. But most importantly, once the structure is put in place, we can run each of those asset classes exceptionally effective, very low cost, most importantly, low risk.
And Steve, let me ask you, what do you think you're best at? When you're driving into work, you walk into work today, you got some clients and you're thinking, this is my thing. This is what I do.
I think my strength is is listening to a client and basically figuring out what is best for that client. And basically, a lot of advisors don't listen. Okay, we listen on there. Again, they have something in their mind to do for a client. What we do is we listen and do what the client needs. I think that's our strength at First Down Financial.
So with all the things that you're saying, I know that you're big in diversification. And when you diversify your portfolio, you include real estate. So can you tell me a little bit more about that? Why do you suggest to at least a small part of the wealth has to be in real estate?
I think real estate has been forever a solid piece of everyone's portfolio.
Mm-hmm.
I mean, a lot of wealth was built off of real estate. So again, real estate should be a part of anybody's portfolio, whether that's your resident, your home, or investment property on there. That again, appreciation has always been there. And when it goes down, it always comes back up. So real estate should be a part of everyone's portfolio.
And do you have anything to do with real estate when you advise them, or is that something separate where you would send them to a realtor like us?
We would definitely send them off to experts like you guys, absolutely. But it is, I guess the problem I have with many clients' portfolios when they come to us is they're overweighted in one particular class. And many of them, it's real
Everything I
estate.
have is in rental property.
We're not talking them out of the real estate. We're just trying to help them diversify across. There's a lot of other places to invest in this planet outside of real estate or your business, right? But both of those are critically important in the asset allocation.
Mm-hmm.
We're just going to shed light and provide options to other areas that, in many cases, have done considerably better with very little risk.
Okay, great. One of the things that we were talking about off camera is a lot of people get older, they buy a rental property, they buy it for $100, it's now worth $400. They want to sell it, and the only way to avoid taxes that most realtors know is to do a 1031 tax deferred exchange. And that's where you basically sell that property and you have to buy another one that's bigger, and then you don't pay the tax. You're deferring the taxes. I understand that you think there may be some better options for that would keep people from having to pay all the taxes when they cash out of their rental properties. And I see that almost every month.
So what would be the best way to mitigate the taxes when you sell a rental property?
Okay, I think as far as one of the most common one used is a charitable remainder trust to sell it inside a trust. As far as for a charity, a lot of individuals don't understand. You still get to utilize that money on the charitable remainder trust. So you're not separating on there as far as. And again, we work through several firms that set those up. So that's a great way. Another thing you can do is if you're selling it in a business as opposed to an individual, you can take some of that and do everything from tax strategies like defined benefit plans and take that profit from that corporation and put it into a defined benefit plan, which is tax deductible, so you can offset it that way. There's annuity strategies that actually will reimburse you the taxes due, so they bonus you on it. If taxes are 15%, you can get 15 and 20% bonus annuities. So you pay let's just say you have a gain of $1 million, 150 grand in taxes. Well, you can go ahead and get a $150,000 bonus in your annuity, just offset your taxes. So there's ways to structure it that way. And then if you want to go more in the DST on there as well, you can go over that.
Probably require a little bit of a deeper dive, but just on the surface,
What's the DST?
it's Delaware Statutory Trust. Essentially, it's a legal entity that is formed to put the assets inside, which is completely acceptable under IRS's 1031 exchange rules. You got to do it within 180 days. And essentially what you do with it inside that trust, there's many different options. You can actually put it inside different types of entities in the trust and actually have a refi or cash out option. So we can go into that in more detail with the client if they want to give us a call on that. It's another hour of discussion here. So for the purposes
So
of
people have a rental and they have, we'll just use $1 million. So they have $1 million and they're looking at $150,000 in taxes, right? But what they're thinking is this DST, which maybe most people never heard of, the Charitable Remainder Trust, that's a CRT, is that right?
CRT.
All these acronyms. They're going to say, well, how much is all that going to cost and how much trouble is it? So how much roughly does all that cost and how much trouble is it to settle that up?
I think the charitable remainder trust can be very simple and inexpensive to very complex, depending what assets, how complicated it is. But again, from a standpoint to what you save to what what it costs is, it's tenfold. I mean, it's way to the advantage of the investor.
So basically, if someone wants to sell a property and they don't want to buy the next property with 1031, they just need to call you, and then you will help them to save a lot of money in taxes.
Absolutely.
In easy words, right?
I mean, the role of any good advisor is to present quality options to your client, right? And help them sift through the decision-making process. This is where Steve and I excel.
I think one of the concerns that people would have is they're selling their property because they want the money for something. A lot of times it's to invest, but they feel like they want the money for something. And I think there may be concern that if they do something that you're talking about, they'll lose control of the money. Is that true? They're like, well, I have this money, I want it. Maybe I'll just pay the taxes on it because then I get to keep the rest. Is that the thinking, or is it?
There are strategies to mitigate those taxes they can get their hands on, and nothing's locked up. So it just depends on what the client's goal is. In many cases, the goal for that asset is legacy, right?
Yes.
So if the goal is legacy, there certainly are slightly longer midterm strategies that can accomplish all kinds of tax mitigation and low risk investing. High performance. It's really the bottom line, right?
Yeah, no, I think that's exactly it on there. As far as legacy is the key point, because if you're selling this, let's just say a senior selling this, a lot of times they don't need the cash. They don't want the cash.
They think they do, but they don't really.
Yeah.
They don't know what they're going to do with it, right?
Yeah. And that's where you can set up a legacy plan through these vehicles and be surprised on, you can mitigate a lot of the taxes on there and just structure it where it's going to benefit not only them, but benefit the entire family, the legacy.
So always you can do it on your own. That's an option. You can sell your house on your own. You can manage your money on your own. Sell your house on your own. We're going to get you way, way more, even with the fee that you pay us. You can pay the taxes on your own. You have the money, but if you spend a little time calling them, they're saying they can give you tenfold.
Well, and again, like you said there, if you pay the taxes on your own and go into an annuity, you can get reimbursed those taxes you just paid inside the annuity. So there's ways you could get that money reimbursed, even if you sell the property and pay the taxes. How do you get that money back?
So you're listening to this because you have some interest in real estate or finances or wealth building. And if you do and you don't understand how to do all this, hardly anybody does. That's why we have you, right? It's worth your while to consult the specialist. Probably doesn't cost much to come in and talk to you, right?
Consultations are free.
And it could save you a lot of money. Seems like a lot of trouble, but it seems like a lot more trouble to sit down at your desk and write a $150,000 check and $1 million.
Painful.
I leave one piece of advice my uncle always used to tell me. He'd say, Steve, stop tripping on nickels on the way to dollars.
Do most people do that, do you feel?
There are a lot of self-managers out there that have done well, but if there's a huge correction, many of them just ride the correction down, whether that's in real estate or the market for that matter. And God forbid you're doing that in retirement. You need to draw income from those assets. It is critical to not lose large amounts of money if you're drawing income off of those assets, whether it's real estate or investments in the market.
When somebody wants to hire you, what would be the first step for them to?
Well, I'm going to give you Steve's cell number. Just send him a text. No, just kidding. Just call the office.
Only on Sunday nights.
Yeah. Surprisingly enough, many of our clients, they'll text us all the time. We're available. Probably too available, but we have meetings on Sundays.
Okay, so I have a few questions, right, about real estate. So one of the questions is, are there ways to reinvest the money and get tax benefits without buying another property?
Yes, there are ways to go ahead and reinvest that through the DST is one way, the Delaware Statutory Trust, or a Charitable Remainder Trust on there, that you can go ahead and use that strategy to reinvest money inside the trust.
And the idea is, instead of paying taxes on your profits, you create one of these vehicles, and the cost on the vehicles, are they large or is it very small?
Very small compared to the tax savings on there, yes. Very small. There is a cost for that through a legal attorney, but it's well worth saving potentially hundreds of thousands and spend a few thousand to set up that vehicle.
Okay, yeah, because usually it's like 15 or 20% taxes on the profit, right?
Absolutely, yeah.
So if you're selling a rental property and you don't want to pay the taxes, and if you're thinking about a 1031 tax deferred exchange and you don't want to buy another property,
There's
you would
another
call
way.
Steve and Steve, and they have some other options, some other vehicles that for a relatively small fee and a little bit of time and effort could save tens and tens of thousands of dollars.
Absolutely.
Especially if they have a legacy goal on that asset.
What is a legacy goal?
The living
Legacy really just the goal is to leave the asset to family, charity, right? Some other type of cause that you may have. That's a legacy goal. You don't need the asset essentially to spin income off to your retirement.
I know that there's ways to get your real estate properties under an IRA or a retirement account. So how that works, and will that save taxes?
Yes, if you go set up an IRA or a defined benefit plan, it's self-directed. You get a custodian, self-directed custodian, and you can do purchases and sales inside the qualified plan, like an IRA or a 401k or a defined benefit plan. And then when you sell it, it's just money that goes into your retirement plan. When you obviously take it out in retirement, it's taxable. But then you're just doing required minimum distribution, small amounts out. So you're, again, retired and not having a high tax bracket to pay those taxes in as well.
So first, to buy a property in a Roth or a simple IRA or some type of defined benefits plan, you have to have the money, right? So you can't just open it up and buy a property.
Yes.
Most of these properties are bought cash, free and clear, correct?
Correct.
Yeah. So if you're going to buy a $300,000 property, you have to have
You
$300,000 in your IRA,
Correct.
right? But then once you buy them, the advantage is
The advantage is you can go ahead and then build that tax-free through a Roth, or you can go ahead and have it taxable in an IRA. But again, you're not going to pay the capital gains midstream. You're going to pay the taxes when you pull it out at retirement.
so when you sell the property for a $300,000 profit, a couple of years later, you just have $300,000 extra tax-free in whatever Roth, simple, defined benefit
Correct.
you have.
So basically, if you have enough money in your retirement account to buy a property, you can buy under the retirement account and pay cash. You have to pay cash, and it's tax-free.
And I find a lot of people who aren't happy with their returns on their retirement accounts, maybe because they don't use Steve and Steve here, they do want to buy a property inside their IRA as a way to diversify. Is that something you help them with?
Yes.
Or is that something you just recommend that they talk to?
Again, we'll provide options to them of what's best to meet the goals. That's the key, especially if it's a legacy goal for that asset. It may be more advantageous in a vehicle like that.
So I have another question. So how does selling an investment property will affect with the annual income taxes?
Well, if you have a rental property and you're receiving rents, that's taxed as income. When you sell the property, that will be capital gains. So different tax brackets for each one of those.
What's the difference in the two rates?
Well, income tax, depending what income you're making, but a lot of times you're in that high bracket. So you can be up to 37% on there, where capital gains tax is going to be capped out at 20, 15 or 20, depending that 583 margin on there.
So what's the capital gain taxes portion?
Capital gains are taxed at either 15 or 20% of the profit of the property upon sale.
Okay, and when is the difference between 15 and 20?
There, as far as 583,000 is the cutoff, when you jump to 20% from 15.
And that's actual profit too. So that's not the sales price, right?
Yes,
So
that's
that
the
would be
profit.
$583,000 in profit, which is most
No.
people don't sell a rental property anymore.
Or said differently, if you have a house with the cost basis or the purchase price is $500,000 and appreciated to $1 million,
Yeah.
that 500 is the profit.
Yeah.
First 500 is what we call cost basis in Steve and I's world, but essentially it was the purchase price.
So most capital gains are about 15%, and if it gets really high, it could be a little higher that year.
You hope it goes to 20.
Oh,
You did better.
yeah.
So what risks can diversification help reduce? Really, it's just the risk of market loss of any market, whether it's currencies, real estate, right? Selling of a business. Diversification, which seems really overused in many circles, it's very important to spread risk out among different asset classes. Real estate, stock market investments, life insurance. These are all asset classes, annuities that are completely uncorrelated with each other, right? The only time these asset classes all went down together, not the life insurance annuities, was during the global financial crisis, right? Everything essentially went down with the exception of gold. But the beauty is the diversification that we will present to clients. There's many of those asset classes that have no risk. A lot of what Steve talked about earlier, there's no risk to any of that stuff. So it's a beautiful thing. Doesn't mean you put all your eggs in that basket either, right? It's just, the key is just having them spread out just enough across different asset classes.
How do you see clients, people watching this not be diversified? What's an example of that? Because they may think I'm diversified.
Well, some people will say, well, they'll come in and be like, yeah, I have 3 apartment buildings, I'm diversified. Okay, great. So your entire $5 million net worth is in 3 properties. Tell me how that's diversified if the rental market falls through the floor. So we'll bring scenarios up to get the client thinking. And there has been times over the last 4 or 5 decades that the real estate rental market is just, the floor is falling out. And then you're left with, a property that's barely paying the bills and there's mortgages on it, right? I don't consider that to be diversification, right? Mm-hmm. So we'll help a client to be more diversified across some of the other stuff, some of the other asset classes.
So ultimately, it's about security. We all think about our money. We all try to build wealth, and we put it somewhere. It's somewhere right now. But what your concern is, I think I'm hearing, is that there's ways to do it with much less risk to get maybe even a better return, so that if we did have a big correction, their income in retirement would not be affected.
Yeah, I mean, the sea change, if you will, of assets moving into the annuity arena has been so dramatic that a lot of the big corporations' pension accounts have taken on a new asset class, and a lot of what Steve I've talked about, which is a brand new frontier for many of the endowment accounts and the pensions that are out there, moving into other asset classes.
Nice.
So when you do the diversification, what percentage should be in real estate?
I think that just depends on the clients, the family situation. Are they still working age? Are they retired? I really think that would just depend. Each client would be different. I mean, I've got some clients, when we met them, they're 95% in real estate on there. They suffered big in 2008 on there. So I think it's really just evaluating and saying, do they need income? Is the real estate having enough income for them to retire on? Do they have a lot of vacancies on there? Do they got to spend money fixing it up on there? So I think each situation will be different, and we meet with them and see some of those options.
It's so complicated. There are so many things to consider that a normal person could study and watch a million hours of YouTube videos and still probably not know everything that you know over the last 41 years. I remember reading something that most people spend more time planning a week vacation to Europe than they do planning their financial future.
Absolutely true.
And that's normal. So that's why you would call these folks, because all they do is plan those 1 week vacation equivalents over and over and over. And after you've done it for 41 years or for 27 years,
27, yeah.
It becomes really easy. It's easy for them. It's worth the small fee for sure.
So what are the benefits of having real estate inside a portfolio?
I think real estate over time has been tested that it's very important to be a part, because real estate has always risen. It goes through its dips, but it always has come back. There's only so much land, so much property. So I think real estate is important as a major part of a portfolio. And then it just depends whether that is it an income property, just a straight investment property that you're going to buy and hold? Are you going to build a home on a property? So I just think, again, but real estate to me should be a part of every portfolio.
Great. we agree with that.
Yeah.
Do you feel most people should have rental property, or when we're thinking real estate, are they thinking mostly just their own house?
I think in that situation on there is, as far as, to me, a property as far as on there, again, it goes down to income, because a lot of times I'll evaluate a property, and after all the expenses of a property, there's a 7% profit based on valuation of that property. And you can make a safe 7 to 10% return without having the headaches of owning a rental property on there. So I think it depends on tenant. It depends on how much work you have to put into the property.
Market.
A lot of retirees, don't want to be, when they reach a certain age, they don't want to be a landlord on there. And they're getting a call at 3 a.m. that our air conditioner just went out, or things like that. So I think it just depends on the situation and how much work you want to put into it. But I think, again, rental properties or your own personal home or just property is all in all is a very good part of every portfolio.
Okay, great. So we really appreciate you to being here, and thank you so much for all the questions and for helping the clients.
Thank you for inviting us.
Thank you for the invite.